As we end the year, a year full of surprises, it's time to take stock and consider the outlook for 2022. While it won't be a repeat of 2021 in terms of robust returns, the MSCI Global Index rose over 17% in 2021, and a 60/40 portfolio, including bonds, gained over 10%. But we do anticipate solid portfolio returns in 2022. So, what's going to drive those returns? Let's break it down. Well, first, we're entering the year with solid economic momentum despite the rise in the Omicron variant. Each successive wave of COVID has illuminated more economic resilience as we've just learned how to live with COVID while mitigating disruption. We anticipate US and European growth will continue above trend, and the fundamental underpinnings remain strong: solid consumer balance sheets and an improving labor market accompanied by wage gains. Next, we anticipate that monetary policy will be less supportive, but financial conditions will remain easy in our view. The U.S. Federal Reserve is going to begin to reverse some of the measures taken at the beginning of the COVID outbreak, tapering bond purchases and potentially increasing interest rates one or two times during the year. Make no mistake, though, this will still leave interest rates very low and policy accommodative. The ECB will remain on hold, likely still in stimulus mode, and we anticipate even more policy support from the People's Bank of China to support Chinese growth. That leads to the final point. The solid macro backdrop and constructive monetary policy outlook should support risk assets. The most important transmission mechanism, though, is through fundamental earnings growth. We anticipate corporate earnings globally to rise in the high single digits in 2022. And that's good news for investors, as earnings will have to do more than their share of heavy lifting to drive returns going forward. Of course, no forecast is without risk, and the biggest risk for investors right now is inflation. And not necessarily inflation, but more so the policy reaction to inflation. If inflation proves to be more sticky for longer, there is a risk that central bankers overreact and drive much tighter financial conditions. Historically, this has been a headwind for risk-taking. That's not our base case, but it's clearly something that bears watching carefully.